Hey guys, welcome to the Macro Maverick. Today I want to talk about the US Swiss franc, specifically going long the US Swiss franc. So we have a monthly chart of it here, and as you can see, technically it seems like there's a narrowing of the trading range and higher lows. So you're looking at resistance at around the 1.02 level and support at the, let's say, 0.95 level. So technically, it seems like a pretty decent long-term setup. Uh, so it looks like it could probably, once it clears that kind of a resistance level at 1.02-ish, it looks like it could probably go quite a long way upwards from a long-term technical perspective. Now, in terms of a quick intermarket analysis, the dollar index here, and you can see that it's been absolutely smashed this current month, and this is the daily chart. You can see that there's a fair amount of selling in the US dollar, if you believe the index. So I believe the dollar weakness is probably overdone, and one of the reasons why I believe that is because here we have the 10-year US Treasury yield. So that's actually 2.06% right now. I'm not sure why it says 20.68, but that clearly it's not 20%. It should actually be 2.068%. Now, as you can see from the long-term monthly chart, the yield has been brought down as well, but not to the extent that the US dollar weakness. So if you look at that candle, that's the current month. That's nowhere near what has been happening on the US dollar chart. And here's the daily chart of the 10-year. Once again, it's the same thing. I don't think we really have that kind of that much weakness going on there in the yield. So I now pull up the IWC, which is a microcap ETF on US shares. You can see it's not looking healthy at all recently. That's not a healthy chart pattern in terms of bullishness. So I suspect what's happened, if you've been paying attention to the news, there has been talk about the Federal Reserve becoming a bit more dovish, and I think that could possibly explain the sell-off in the US dollar, which I suspect is overdone, just because bond yields aren't really pricing in as much weakness as the US dollar has. And if we look at the microcap stocks, you can see there's a fair bit of weakness, but if we actually look at the S&P 500, that weakness is probably not as obvious, and in fact we're at new record highs. So I suspect that the market is just overreacting to Federal Reserve's supposed dovishness. So that's really, from an intermarket perspective, I think it's just a bit of overreaction because the bond yields just haven't really followed the same pattern as the other markets, such as the US dollar and the S&P 500. Now, the going long the US Swissy will actually give around almost a 2.5% positive carry, so you're actually earning 2.5% holding the position. As I've mentioned, the monthly chart looks quite like a nice setup at the very least for a break to the upside. Now, looking from a daily perspective, it clearly looks horrible, although I suspect in the past couple of days that's been overdone, that selling. Now, having said that, I think if I was short the US Swiss franc at the moment, I would probably want to see it come down a little bit more before I actually close my position. So potentially we want to get out when all the short sellers taking profits. And I would probably say the 0.96 level is actually a good level to get in. At the end of the day, this is just a very nice positive carry trade, and even if the Federal Reserve cuts interest rates, we're still getting pretty decent carry on being long the position. So just food for thought. I'll be having a look at this next week when the markets open up again. So that's it for this video. Thanks for listening.